Is the smart money running for the exit? If you track institutional flows in the Singapore market, you witness something startling in the second week of November 2025. The top name on the sell list wasn't a distressed penny stock, it was Mapletree Industrial Trust. For years, MIT was the golden child of the S-REIT sector, the perfect blend of steady industrial dividends and high-growth data centers. But now, that growth engine is precisely what is terrifying institutional investors. In this video, we are going to perform a forensic analysis of the sell-off. We aren't just looking at the what, we are looking at the why. We will dissect the mathematics of the potential AI bubble, the specific vulnerabilities in MIT's North American portfolio, and why the market is suddenly pricing boring logistics assets higher than sexy AI infrastructure. But first, a quick disclaimer. The content in this video is for educational and informational purposes only and does not constitute financial, investment, or trading advice. I am not a financial advisor. Please do your own due diligence or consult a licensed professional before making any investment decisions. Now, let's look at the macro thesis. Why is the market suddenly scared of data centers? The analysis points to a terrifying disconnect in the AI economy. We are currently in a phase where capital expenditure, the money big tech spends on building data centers, is sitting at an unprecedented $371 billion annually. But here is the catch. The revenue generated by AI software is projected to be only $60 billion in 2025. As an investor, you have to ask, how long can companies spend $371 billion to make $60 billion? This is what we call the revenue justification problem. The canary in the coal mine is the rental rate for GPUs. The report highlights that rental rates for the Nvidia H100 chip have crashed from nearly $3 per hour to under $1.65. This collapse signals oversupply. And if chips are cheap and available, the desperate need for more data center space starts to cool off. This brings us specifically to Mapletree Industrial Trust. Why was MIT targeted by sellers more than others? It comes down to portfolio composition. MIT has pivoted aggressively. Today, 55.6% of its assets are data centers, with a massive chunk of that located in North America. 2 years ago, the market paid a premium for this exposure. Today, they view it as a liability. The fear is that if the AI bubble bursts, or even just deflates, US vacancy rates, which are already showing softness, could spike. However, my analysis suggests the market might be overcorrecting. Here is the nuance that the panicked sellers might be missing. MIT is not a pure-play data center REIT. It is a hybrid. 44.4% of its portfolio is boring, traditional industrial real estate in Singapore, business parks, flatted factories, light industrial buildings. In a bull market, these assets drag down growth, but in a bubble scenario, these assets are the anchor. They provide a floor to the cash flow that a pure-play REIT like Capitaland DC or Digital Core REIT simply does not have. Let's evaluate management's response to this crisis. Usually, when a sector gets hot, REIT managers get greedy. They borrow maximum amounts to buy more assets at peak prices. MIT did the opposite. In the last quarter, they executed a strategic retreat. They sold off $365 million worth of older assets and used the money to pay down debt. They lowered their leverage from 40.1% to 37.3%. This is a masterclass in defensive balance sheet management. By lowering leverage now, they have protected the dividend against rising interest costs and created a buffer in case asset values drop. An interest coverage ratio of 3.9 times means their dividend is safe, even if income takes a temporary hit. Now, let's move to the comparative analysis. If you are holding MIT, you need to know how it stacks up against its rivals, Capitaland Ascendas REIT and Capitaland DC REIT. The flows of money tell a fascinating story of risk on versus risk off. Institutional money is flowing into Capitaland Ascendas. Why? Because CLAR only has 8% exposure to data centers. It is the safe haven. Investors are willing to pay a premium. CLAR trades at 1.25 times its book value just to avoid the AR volatility. On the other extreme, you have Capitaland DC REIT. It is 100% data centers. It is high risk, high reward. Despite the fear, they are raising cash to double down on Tokyo assets. So, where does MIT sit? It is trading at a much lower valuation premium than CLAR, offering a yield of roughly 6.2% versus CLAR's 5.4%. The market is essentially charging MIT a risk penalty of 80 basis points for its data center exposure. But the question for you is that penalty fair? We also need to address the macroeconomic paradox. In September 2025, the Federal Reserve cut rates. Historically, when rates fall, REITs rally. But in Q3 2025, data center REITs barely moved, up only 2.6%, while office REITs surged 18%. This proves that fundamentals are currently overpowering macroeconomics. Investors are so worried about the AI oversupply that they are ignoring the benefit of cheaper loans. However, MIT has hedged 93% of its debt. This is crucial. It means that even if market rates stay volatile, MIT's interest expenses are locked in at a very low 3%. They have insulated themselves from the financial shock, even if they can't hide from the market sentiment shock. So, what is the verdict? How do we play this? If we look at the forward-looking scenarios, we see three paths. Path 1 is the bear case. The AI bubble bursts hard. In this scenario, MIT's North American vacancy rates rises, and they might have to cut DPU by 5 to 10%. Path 2 is the bull case. The demand catches up to the supply, and MIT's heavy bet on US data centers pays off with massive capital appreciation. But the most likely path is the base case, rationalization. The hypergrowth slows down, the weak players get crushed, but quality assets in key hubs like Northern Virginia and Singapore remain full. In this scenario, MIT is a hold. It offers a 6.2% yield while waiting for the market to stabilize. Here is my conclusion. The institutional sell-off is a warning, not a death sentence. It is a rational adjustment of risk. But if you are a long-term income investor, the current pricing of MIT looks like an opportunity to buy a high-quality asset at a fear-induced discount. You are getting a 6.2% yield from a company with low leverage, a strong sponsor in Mapletree, and a defensive industrial core that protects you if the AI narrative falls apart. Now let's look at the metrics. The major market trend is watching the occupancy rate of the North American portfolio. If that number holds above 88%, the institutions are wrong. If it slips, the bears are right. I want to hear your take. Are you buying the dip on Mapletree Industrial Trust, or are you fleeing to the safety of Capitaland Ascendas? Let me know in the comments. If you enjoyed this deep dive, please like and subscribe. It helps the channel immensely. I'll see you in the next market analysis.